Welcome back. Today we're looking at an analysis report called BYND, Trap or Treasure, the truth about today's rally. It does a great job contrasting the stock's technical rally with its pretty severe fundamental risks. So let's start with the first point. The analysis report's high-impact rhetorical style. While it's definitely engaging, it risks undermining the objective rigor you'd expect from sophisticated financial analysis.
Right.
I mean, it makes a really strong case for high volatility. It calls buyers gamblers. It talks about option lottery pricing, and, the final advice is to treat the stock like a stick of dynamite.
And I get that instinct. I really do. The goal is obviously to capture the chaos of this particular stock move, to really scream risk.
Exactly.
But, and here's the issue, when you're also presenting a very smart breakdown of the balance sheet, using that kind of language like falling knives, gamblers, don't be the bag holder, it can hurt the report's credibility.
It's a strange effect, isn't it? The tone itself starts to feel like the retail hype you're trying to warn people about. It kind of overshadows the really powerful data that's underneath all that language.
That's it precisely. For an institutional reader, or just anyone looking for a serious assessment, that tone immediately sets off alarm bells. It doesn't matter how good the numbers are.
It feels counter-analytical.
It does. The analysis should be reporting on the hype, not participating in it.
Okay, but let me push back on that for a second. If you soften that language, don't you risk losing the urgency? If the stock really is a stick of dynamite, does changing a header to something bland like drivers of speculative interest really get that danger across?
That's a fair point, a really fair point. But it's not about losing the gravity. It's about shifting where that gravity comes from.
Okay.
You want the urgency to come from the hard financial data, from the implications, not from the writer's emotional language. So the suggestion is to, recalibrate the voice in those key analytical sections.
To sound more authoritative?
Exactly. A more sober distance that actually shows a deeper mastery of the topic. You're showing the danger through quantified risk, not just by shouting a warning.
So the authoritative tone is actually more frightening in a way. I see. So what would be a concrete, actionable change here?
Well, let's start with the headers. Swap out the colloquial ones. Instead of, why gamblers are buying the dip.
Right.
You could change that to something more neutral, more authoritative. Maybe the bullish thesis, drivers of speculative interest, or even just technical drivers of the recent price movement.
That small change alone just completely reframes the section.
It does. And second, that conclusion, that dynamite metaphor. We can achieve the same warning with, I think, much greater gravitas.
How so?
You replace the metaphor with a more formal warning. Something about, managing volatility risk, maintaining rigorous position sizing, capital preservation discipline, that kind of language.
Ah, I see. It moves it from sounding like advice from a friend to a directive from a portfolio manager.
And that's a critical distinction for this kind of audience. It builds huge authority.
Okay, that makes perfect sense. Let's shift gears. The second point is about the core of the trap case, that dilution disaster. The report is right to call it critical, but I feel like the full, devastating impact isn't quite crystallized for the reader.
Yes, the observation itself is so powerful. I mean, you look at the section, it notes the historical share count was what, around 64 million?
Yeah, 64 million.
And that has just exploded to over 450 million shares. And it correctly concludes that the all-time high market cap is mathematically almost impossible to reach again.
Right, and when I read that 64 to 450 million comparison, I knew it was bad. But I still felt a bit of an analytical gap. I had to sort of stop and do the mental math myself to get that real stomach drop feeling.
And the report needs to deliver that gasp moment directly.
Yes.
Without making the reader do the work.
That's the weakness, exactly.
The raw numbers are shocking, sure, but the report doesn't translate that dilution into a tangible measure of value destruction. It makes an assertion that the old high is impossible to reach, but it's not a quantified fact within the report itself.
So the suggestion is to just do the math for us. Directly integrate a historical quantification of what's required now.
Exactly. You have to turn that assertion into undeniable evidence. If you explicitly translate the historical peak market cap into the share price required today with the 450 million shares, then the trap case becomes just, mathematically undeniable. It's so much more impactful.
It's all there, all the ingredients are in the report. It just needs that final step of presentation.
It really does. So concretely, you calculate the exact market cap at the stock's peak using the old 64 million share count. You state that dollar figure clearly. That's your anchor. Then, the crucial step, calculate the required share price for BYND today with 450 million shares to hit that same market cap.
So you're showing the reader not just the height of the mountain, but that the cliff face they have to climb now is just so much steeper to get to the same altitude.
That's a perfect analogy, and you present it clearly. Something like, to achieve its historic peak valuation of X billion dollars, the current share price would need to be Y dollars, meaning the stock needs a Z% move.
Just to return to its valuation, not its previous stock price.
Yes. That makes the analysis robust. It's no longer an opinion. It's financial modeling. The impact of that dilution becomes the central, unshakable pillar of the whole trap thesis.
Very effective. Okay, so that covers language and the quantitative evidence. Let's move to our third and final point, which is about the structure of the analysis itself. While the final verdict does a great job separating the trap for investors from the treasure for day traders, the sections leading up to it feel too rigid. They're too separate.
I noticed that too, that structural isolation. You've got Section 2, the treasure case, which is all about the short squeeze potential, and then Section 3, the trap case, with the fundamentals, like the revenue decline and the huge quarterly loss.
And the tension between those two realities? That's the whole story of this rally, isn't it? The short-term pop versus the long-term collapse?
It is.
But because the cases are isolated, that great dual conclusion at the end doesn't feel like it was earned in the body of the report. It just sort of appears, fully formed.
That's the weakness right there. By keeping the bullish and bearish cases completely separate, the report misses the chance to show the active tension between these forces during the analysis. The reader has to wait until the end to connect the dots between a 13% revenue decline and a potential 200% gain on a trade.
You're forcing the reader to hold two separate ideas in their head the whole time. It's a lot of cognitive load.
It is. So the suggestion is to integrate that investor versus trader viewpoint directly into the body of the analysis, right from the start.
Okay.
It'll make the core message that BYND is two different stocks depending on your time horizon so much stronger. It shows a really sophisticated grasp of market dynamics.
I do have a question about that, though. My one worry would be creating confusion. If you're constantly switching between trap and treasure in the same paragraph, how do you keep the argument sharp?
That's the key challenge, and also the key opportunity. You overcome it with really clear contrast framing. You discuss a technical point, and then you immediately pivot to the fundamental counterpoint.
So an example would be...
Okay, when you're discussing the short squeeze potential, you could follow it up immediately with a framing statement. Something like, for the long-term investor, this volatility is just noise, a threat to be avoided. But for the nimble trader, this is the primary alpha opportunity.
Ah, I see. So you're acknowledging the duality of the market behavior in real time. It keeps both readers engaged.
Exactly. And you can do the same in the financial bleeding section. You connect the cash burn to the dilution trap, and then you immediately contrast it. While this cash burn is an existential threat to the investment thesis, the day trader treats it as a purely technical event, betting that the structural risk won't materialize in their 48-hour window.
That makes the whole analysis feel so much more dynamic. It feels like it's rooted in the actual market tension happening right now, not just a list of pros and cons.
It elevates the whole argument. The research here is really strong.